probably the biggest market news last week was the rise in inflation, up 5.4% year over year in June. And the market itself was down about 1% over the week. But what's interesting here is you didn't get much of a reaction from traditional inflation hedges. The Sprott Physical Gold Trust was basically flat on the week. And if you look at crypto, Bitcoin was down 2.55%. So one takeaway from that is if you want to hedge against the market going down because of inflation or some other reason, the best hedge on any asset is put options on that asset, because they're going to go up when the particular asset goes down. So if you have put option hedges on the S&P 500 or an ETF that tracks it, and the S&P goes down significantly, those put options are going to go up. Whereas gold may not go up, Bitcoin may not go up, oil may not go up. You don't know. There's not necessarily going to be an inverse correlation between the market and commodities or crypto, but there is going to be an inverse correlation between the market and the right to sell the market at a higher price than what it may potentially drop to. So with that in mind, let's look at a way you can hedge your portfolio against market risk. And for this example, let's say you've got a portfolio that it's worth $1 million. So first thing we'll do here is we'll look up the current price on SPY, and that's 431.34 as of Friday's close. Get to you later. We'll open up our calculator. We'll type in 1 million, and then we'll divide by the number we just forgot, which is 431.34. Okay, so $1 million is roughly 2,318 shares of SPY. So now we'll open up the portfolio on our iPhone app, and we'll enter in SPY as the symbol, and then we've already forgotten the number of shares. It's 2318. So we'll go ahead and enter that here. And then in the next field, we'll enter our risk tolerance, the largest decline that we're willing to risk over the time frame of the hedge. For this example, I normally use 20% because that's a good compromise between not risking too much and not paying too much to hedge. But let's say you're slightly more risk averse than that, and we'll use 18%. And we'll use our default time frame to expiration, which goes out approximately 6 months. So it goes out to January 21st. And here, the cost was $18,193, or 1.82% of position value, to hedge against a greater than 18% decline in a $1 million portfolio highly correlated with the market over the next 6 months. Let's look at a couple ways we can possibly lower that. The first thing we can do is try to round up the number of shares of SPY. We have 2318, so right now our hedging algorithm is over-hedging that 2300 to cover those other 18 shares. Let's see what it looks like if we raise that to 2400 shares. So right now it costs $18,193, and let's see if it's lower with 2,400 shares. And in this case, it is slightly lower. It's $18,096, and that goes down to 1.75% of position value. And again, that is calculated conservatively using the ask price of the puts. In practice, you can often buy and sell options at some price between the bid and ask. So let's just double check that, how much higher it was if we used 2318 here instead of 2400. Yeah, okay, you're saving about $100 here, a little more. Okay, so back to 2,400 shares. And the other thing we can try is we can try a different time frame and expiration. So we went out to January. Let's try going out to mid-December. And here we lower both the total cost goes down to $14,232, and the cost as a percentage of position value goes down to 1.37%. The annualized cost here is 3.28%. So we compare apples to apples, and let's see if the annualized cost, just remind ourselves, it's actually slightly higher if we go out to January. So the advantage here with a January hedge is you've locked in a relatively low cost for a longer period of time, and the advantage with a December hedge is it's a little bit less expensive, both in terms of dollars and if you annualize the cost. So the other thing you could do is you can go in the opposite direction. If you think that volatility is going to increase and it's going to get even more expensive to hedge in the future, you could go out to, say, January of 2023. And if you do that, though, the cost goes up and the annualized cost goes up as well. Right now it's 4.51%. So unless you think there's going to be a huge spike in volatility between now and January of 2023, you're probably better off looking at shorter time frames to expiration, such as this one that expires in January of 2022. So something to consider if you're concerned about inflation or you're concerned about other kinds of market risk and you want to limit your downside risk without exiting the market.